There's a quote on the Bloomberg story today. It took 3 days to get over Brexit, 3 hours to get over Trump, and about 3 minutes, maybe, to get over what's happened in Italy. Why?
Well, I think you said it right. I mean, the polls got it right for the first time. Maybe not the size of the margin. That was a little bit of a surprise. But I think it's, the Italian politics are extremely complicated. I think the chances of a next snap election in early 2017 as opposed to the scheduled election in early 2018, those chances are still relatively low, and I think that's where the market would be most worried about. So I think some of the details around the dynamics are what's kind of precluding a major risk-off move here. Euro,
$1.07. A lot of excitement about parity calls year-end 2017. We've heard those calls around this table several times. Populism, how will that affect, though, the FX market? Because the doomsday scenario is you've got to know the five-star movement win a snap election, then they manage to change the constitution and have a referendum on Eurozone membership. That is a lot more simplistic and a lot more difficult, actually, than it sounds. For the markets, though, how do the politics infiltrate the FX market in the year to come?
Well, I agree. For the record, parity wasn't our call. But look, I think the euro and the Eurozone bond market are not the same as they were in 2010. I think we have to realize that. I think we heard this from the ECB last week in terms of those source stories of potentially supporting the Italian bond market. 66% of the Italian bond market is actually owned by domestic residents at this point, so there's a lot less international pressure. The ECB can always step up buying. And Eurozone as a whole is a massive current account surplus economy, so the Europe looks very different, which is why I think political events affect the euro very differently. So I think, yes, I think if you get to a point where you have this massive contagion and we're starting to ask existential questions again, then the euro would weaken, but we're pretty far from that point in our view.
And to sort of illustrate what you're saying, you take a look at the Bloomberg here. This is BNP Paribas Political Risk Index. You can just really show that kind of divergence. That white line, though, is volatility for European stocks, so not in terms of a euro. But nonetheless, it still remains quite elevated. We have all those elections coming in 2018. So if you don't see a weaker euro, what kind of volatility do you expect over the next, say, 18 months?
Well, I think you should still be a buyer of sort of medium to long-term vol. I think the risk is there. I think the French elections clearly, represent another chance for the sort of non-establishment movement to kind of show itself. So I think the political risk is there, but also, look, let's not kind of overplay political risk here as well. We have big movements happening in the bond markets anyway. We have the steepening in the yield curves. We have rising global bond yields. So it's a complex process. I think politics is part of it. But as we've seen many times, I think, over the past couple of years, it just does not generate sustained volatility.
Well, let's not overplay it, but the market is certainly not overplaying it in any way, shape or form. BTPs are down, yes, but the euro's stronger, equities are resilient. Is there a risk that actually we go into next year with the lessons of Trump, the lessons of Brexit, the lessons of Italy, and we actually underplay political risk? Because, yes, there's a lot of research notes out there, but really the market and the price action says something different.
Well, that's the nature of the market, right? You swing one way too much and then the other way. Yes, I think we spend a lot of time thinking about, our markets being too optimistic maybe next year on growth, too optimistic on fiscal stimulus. There's clearly a lot of enthusiasm about the new state of the U.S. economy, perhaps fiscal spending, infrastructure spending, and all of this has given, quite a bit of support to the equity markets, even as we've said, bond yields are rising. So yes, I think there's a danger that, in fact, when we move to the middle of next year, past the first 100 days of the presidency, maybe reality sets in that there's not that much change happening in the U.S. economy, not that much growth acceleration, and some of those trade tensions coming through. And we could see a more risk-off sentiment in the middle of next year.